Okay, we'll start the Q&A in a second, but before we get there, let me mention something first. This is a level 1 curriculum for the CMT. CMT is the Chartered Market Technician. It's an introduction to technical analysis, and I've noticed that in the last few market updates, I have put a little bit of technical analysis in there, and it's been well received. There's about half of TA that I just don't buy into. And there's another part of it that I think is very useful, especially volatility. Technical analysis gets into volatility quite a bit, and intermarket analysis, which is really part of a top-down strategy. If you're using any kind of top-down analysis of the market, intermarket analysis, I think, is a really useful and powerful tool. What I don't like about technical analysis is when it starts to get into all of the really deep mathematical indicators, trying to measure slight changes in volume versus this, that, it can go a little too far, and I sort of don't like it there. However, there is in the CMT curriculum, level 1, 2, and 3, there are quite a few useful things that, I've been through the curriculum and I've looked at it and go, well, I use this and I use that, and I have no problem with this and I have no problem with that. Most of level 1 I've been through, I go, well, this stuff is not so bad. This stuff is useful and it's worth knowing. So here's what I'm going to do. If you have the applied series, I wasn't going to add anything like this, but then I looked at it and I thought, why not? Because if you're looking for something applied, technical analysis is really, really applied. But, a warning, it does go into areas where you kind of got to roll your eyes a bit and say, oh, come on. Now this is getting a little ridiculous, and yeah, it does that. But there is still quite a lot of good stuff left. So if you have the applied series, you'll notice a new folder show up that you'll have access to, a new module called Technical Analysis. And what I'm going to do is I'm going to go through the entire curriculum, level 1, 2, and 3. Level 1, 2, 3 combined is about the size of level 1 CFA. Each level's really not that big. Each level's like one book, like 600 or 700 pages, and that's really about it. By the way, if you're a charter holder, if you're a CFA charter holder, you already have level 1. You get that for free. If you want the CMT, you don't have to write the level 1 exam. It's just given to you. You start at level 2. Level 2, I think, it's one book, and I think it's like 600 pages. That's it. That's it. It's nice and easy and quick to get through. But you'll notice that this will start showing up in the applied series, and I'm going to try to get about 2 or 3 readings up per week. And the readings are not long. Every reading is about 9 to 12 pages. They're really not long at all. So every video is like 6 or 7 screens. They're really easy to get through. I'll just include that in the applied series. So if you are subscribed to the applied series, the entire CMT 1, 2, and 3 will show up over the next, however long it takes me to get there. But that will show up. Let's get to our questions. Let's get to some question and answers, and some real good ones this week. First one, in your opinion, who would you enjoy seeing the Fed chairman become if Powell suddenly resigned? In other words, if you had to choose a new Fed chairman, who do you think would serve the U.S. economy the most efficiently? At this point, I think you need an outsider. You couldn't promote from within. And I think you'd need somebody who's not from Wall Street, and somebody who's not a pure academic. You'd need somebody that, maybe did a tour of duty in the financial markets, has a good economic background, and is more academically inclined. So something like Mohamed El-Arian, I think, would probably do very well, bring a new focus in, an outside view, because I think there's a little too much groupthink that might be going on at the Fed right now. So that would be my pick. Next, there are three questions in here. First one, despite core and sticky, couldn't the Fed saying core inflation would step down over the next 2 years be because the members see a positive resolution of the end of the Ukraine war, leading to a sudden drop in core, given that they said anticipated resolution of supply-demand imbalances? No, I don't think that this statement, when they made any statement about what their expectations are, I don't think that they make any statement anticipating an exogenous event. So the start of a war is exogenous, and the end of a war is exogenous. There's nothing monetary policy can do to affect any resolution to that war. The ending of it would be exogenous. In other words, it wouldn't be a market determined. It would just happen from outside the market. It would be welcome. I think it would do something to reduce headline inflation. I think it would have more of an effect on markets than on inflation. But as far as core, I don't think it would do anything to core. Because I don't think it's going to fix the housing shortage in the U.S. I don't think it's going to fix the level of rents. I don't think it's going to affect owner's equivalent rent. And I don't think it's going to do anything to affect the labor shortage in the U.S., which means it's not going to do anything to affect wages, and it's not going to do anything to the expectation of employees after getting 2 years of easy wage hikes. I shouldn't say easy, but outsized wage hikes, to suddenly hit a wall, the next year where management says, okay, we're going back to the 2 to 3% wages we used to have. That business is over. We're going back to 2 to 3%. Something once given is hard to take away. That if you are used to, every year you're going to get a 7 or 8% raise or a 5% raise, and suddenly it drops, that's going to be a problem, especially if you have a tight labor market. That 3% raise is going to walk across the street to get a 6% raise. So unless you have a higher level of unemployment and you have a labor market with significant slack in it, you're not going to be able to get those wage gains out of there. The ending of that war isn't going to do anything to fix that. It may help with supply channels. It may. I don't know that it will, but it may help with supply channels. But we don't have a problem in North America right now with inflation in goods. In fact, there was zero inflation in goods in the last report. And most retailers are reporting an abundance of goods. So we don't really have that issue. It might push down prices more, which means you might have some deflation in goods offsetting the inflation in services, which would make core appear to be lower because goods are dragging it down. But beyond that, no, I don't see a resolution there unless you can solve the housing issue, unless you can create more housing units, and unless you can create a larger labor force. I don't see that dropping quickly, I should say. Not that I don't see it dropping, but not quickly. Not even with an exogenous event like the end of a war. To what extent are Republicans a hindrance to fiscal policies like the one you described with respect to labor reducing CapEx tax cuts? Well, the point I was making when I said that they would block it is they certainly wouldn't. It's not because they disagree with it or they're a hindrance. It's that they're not going to let the Democrats have a win. And if it were reversed, the Democrats aren't going to let the Republicans have a win. That's what politics has come down to in North America, both Canada and the U.S. Is we're at the point now where the opposition's main goal is not to find a balance in legislation so that it's more centrist, but it's to stop the other side from getting absolutely anything done so they don't get reelected. So unless you have let's say 2024 onwards, unless you have all three, a party controlling all three, the Senate, Congress, and the White House, you've got to do nothing. You've got do nothing Washington, because it's about blocking as much as you possibly can. You just block, even if it's good. You can't let the other side win. And it has been that way for some time now. Politicians are not there for your best interest. They're there for their best interest. You're secondary. They only care about you at election time, and they'll tell you what you want to hear, but they don't really give a shit about you at all. And this is the problem with Western democracy, particularly in North America. I'm not too familiar with Europe, but particularly in North America, is good people won't run for office anymore just because it's such a mudslinging shit show. So good people just say, I don't need that. I don't need my whole life opened up and displayed for everybody to see. Yes, I've made mistakes, and I don't want to have to relive and relitigate all the mistakes I've made. I've learned and grown from my mistakes, but I'm certainly not going to put up with that. So good people simply just don't show up there anymore. And the American people, Canadians too, don't vote for qualified people anymore. Qualifications are meaningless. They vote for popular people. And popular people these days seem to be more extremist than centrist. So that's where we are. Until that ends, that's what we got. We have to look to our business community to be leaders and to grow the country and to do what's right for the country. And we put up with the politicians more like a sideshow. It's like the show you got to watch before the real show you want to watch on TV, but they stick the loser show in front of it to try to build an audience. Well, government is the loser show that we got to put up with before we get to the real show. What indicators do you look at to know whether Thursday's move was a short squeeze? I don't know that there were any indicators that I looked at. I was just as surprised that morning by the rally, I think, as anybody else. You saw the market go straight up on this news and you thought, wow, this doesn't make a lot of sense. So you have to think it through. I mean, okay, maybe there was no reason to go any lower, but to suddenly just touch the wall at 35 and go running straight back up again didn't make any sense to me at all. But, when you have time to digest information, you can sort of come to explain it. And we as humans, we want to explain things. We don't like things that are unexplainable. We try to come up with a story that explains things. So it was more just intuition, gut feel, experience, where I thought this is the wrong reaction altogether. This is completely the wrong reaction altogether. I don't believe this, and that's it. Now, there could have been the confluence of both a technical and a fundamental bounce. If inflation had come in better than expected, and we still had sold off in the morning, hit 35, and went up that day, I wouldn't have been too eager to sell calls, because there was a fundamental reason why. Inflation came in lower than expected, but it came in hotter. And one thing I know about technical bounces is that's what they are. They're simply just bounces. They're not the beginnings of new rallies. They're simply just bounces. You need fundamental support for the beginning of a new rally. A new sustainable rally needs fundamental support. Technical indicators can help you identify when a new primary trend has begun, but lacking any fundamental support for a new bull market, any bounce off a level is just that, a bounce. And we know when things bounce, they do this, and they eventually lose momentum, right? It is just a bounce, and a bounce is not a rally. It's just a bounce, so we can short those. Okay, first comment, 3 questions embedded in here. First one, let's see, from staff review of economic situation. Real goods exports stepped up. Real goods imports stepped down. Is that not in contrast to economic theory of a strong dollar supporting more imports and exports? Are there other reasons to explain this? Yeah, it's the type of goods that are imported versus exported. The U.S., when you look at the composition of their imports, they tend to be discretionary products. In other words, stuff you find in the malls, stuff you find in a clothing store, stuff you find on the shelves of Walmart, etc. Well, we've heard from a bunch of retailers in the second quarter that they're awash with inventory. They've got lots of inventory of that kind of stuff. So they're importing less, not because they have, listen, we got a really strong dollar, let's import more. It's, look, we don't really need this stuff. Even though we got a strong dollar and it's cheap to import the stuff, we just don't need it. The U.S. tends to export more capital goods as opposed to discretionary goods. So capital goods are, robotics and things like that, labor-saving investments. So that tends to hold up. Next one, if the volume of downgrades outpaced the upgrades in September and credit is still sound overall, have rating standards increased? I don't know. I don't think so. And could we also see safe haven in some high grades that are down the pecking order, like triple B? I'd say low grades or high yields. Well, that's what the market is saying. If you look at the credit spread, the OAS, the market is not really that concerned. Yes, credit spreads have widened, but when you look at other periods in time, they're still rather narrow compared to 2006, 2007, 2020, 1999, 2000, 2001. They're still rather narrow compared to that. So at this point in time, based on where the OAS is, that seems to be what the market is saying. And that could change. That's why we look at the OAS every week to see what the market is thinking about the risk in credits. Next one, with access to credit expensive and risk capital demanding hefty premiums and the inherent risk in cryptos, do you think crypto winters are here to stay for a long time as they heavily rely on funding? I really don't know how that whole market works. I don't know if they rely on funding. I really don't know that to be true or false, so I can't comment on that. Do you see them getting wiped off completely if they are starved for far too long without funding, or is there an escape route? Who cares? Who cares? What function does it serve? If it is nothing more than I'm going to buy some of this stuff in the hopes that I can sell some of this stuff higher, if that's the function it serves, is just a transfer of wealth from a group of people to another group of people. If that's all it is, then it really serves no particular function. There is no useful function that it serves. I don't know that it's a transaction currency. Sure, it can act like one, but I don't know that it is. I don't know that it functions that way. It primarily functions as a very broadly globalized, socialized Ponzi scheme that is a gift for scammers and thieves. I don't know that you could design anything better for criminals than something like this. So, in my opinion, it has no functional reason that if it disappeared, who would be disadvantaged? Right? That money would just go into something else. Anybody who's buying that speculatively would go buy something else speculatively. So unless you can actually give me good reasons why it has a function, I think the true value is zero. Let's assume for a moment that it did become an alternative currency that is not open to manipulation. It would be outlawed in every single country so very, very quickly, because no central bank would allow that to happen. No central bank will lose control of the power that they have, and no government would allow it either. If it served as a conduit for money to leave a country because there was fear in that particular country, it would be shut down in half a second by the government. And because of that, because there is no one person controlling it, it has no long-term viability. A socialized movement, a leaderless currency, a socialized product like this is bound to disappear over time as soon as the euphoria ends. So no, unless there's some significant body behind it that's controlling it, no. And for those of you out there who say, but that's exactly what we want, something with no control. No, you don't. No, you don't. You think you do. You think you want something with no control. But if you ever had something with no control, there is no one to step in to save you. Nobody to step in to save you at all. You simply lose. It's not as if everyone's just going to get along. There's this belief that, if we live in a post-structural world and we tear down the system, it'll be this brave new world and we'll all just get along. And it seems to me ironic that the very scrawny little guys screaming in the streets to tear it all down are the ones least capable of surviving in a post-structural world. That they're the ones who would need the safety of structure more than anyone else. So you think you would like to have something where nobody controls it, but you would not. If you thought it through, you would not. Let's see. I'll bet your answer to this will be you don't know. No one really knows. Still, what are your thoughts on countries like India, China, Russia looking settling commodities like oil in their own currency rather than the US dollar? I know India is putting a framework for trade settlement with rupee, with some other currencies too. Any thoughts on long-term outlook of dominance of dollar as the only reserve currency? Well, the dollar is the currency of international trade, really. That does not mean you couldn't have idiosyncratic trade with other currencies where two other countries say, you know what, this dollar nonsense, it's killing us both. Why don't we just do it in our own currencies? That just introduces a bunch of risk between the two countries. Does China want to hold rupees, and does India want to hold the yuan? Or are they going to just sell it and move it into their own currency as quickly as they possibly can? If I'm trading with another country and I say, well, you got to pay me in US dollars because I have other trading partners that need to be paid in US dollars. So me selling this to you is my source of the US dollars I need to buy this. I'll sell you oil, but you got to give me US dollars so I can pay this other country for their food because they want US dollars. So other than idiosyncratic deals between two countries for a particular commodity, I don't know too much that the dominance of the US dollar is threatened here. However, all of those little idiosyncratic deals do whittle away at the need and the demand for US dollars for that particular bilateral trade. So let's say India to Australia, for example, that there is some form of bilateral trade where they say, look, we have a certain amount of trade anyways between our two countries. Why don't we denominate just that level of trade in our two currencies? And, we would be no better or no worse off in terms of the amount of US dollars that we collect. So you could get it done bilaterally, but big trade agreements among blocks of countries, unless there's a viable alternative, and right now there is in the world, there is no real viable alternative. You need a big currency. So you have traditionally was the yen, the euro, and the US dollar. It used to be the British pound for a while as well, back in history. But you need a currency that you can have faith in. Well, it's a matter of TINA, right? In the currency market here there is no alternative right now. So yeah, bilaterally, sure, but large trading blocks of it, I can't see it. Okay, listening to the language in the Fed minutes, especially the better do too much than too little, and the non-reaction of multiple sectors of the economy, why not give it a good shot? May mention low downside risk to the job market, so why not a 100 basis point increase to show everyone they are done playing? I feel like they always raise rates on par with expectations, and this may be a reason for the underreaction in some sectors of the economy. I was looking at the news feed tonight, and there was a headline out that I think it was the Minneapolis Fed, or was it the Atlanta Fed? I forget which one, but one of them was pushing for 100 basis points in September, not 75, but for 100, and I think 9 out of the 12 had voted for the 75. 9 out of the 12 banks were leaning towards the 75. Not voted, but leaning towards the 75, because there's only 5 of the banks that are on the voting committee. But maybe they polled the room, and that's how they got that number. So there was talk of the 100 on the table, that you could see 100 in November, because inflation is coming in hotter, and the argument is right. Better to do too much than too little. The language suggests that 100 would not be out of left field based on what they're saying, and based on noting the job market is strong. Industrial production and output is showing modest gains. They talked about that. So, yeah, they could go 100. They could. The market isn't betting on 100. It's basically looking at 75 as being a sure thing at this point. What is your take on the expected interest rate path on the Canadian side? The CPI level has been coming down in the past few months in Canada, But some analysts, economists argue that Canada has no choice but to follow the Fed's interest rate path to protect the value of the CAD. That is an issue. Unless they, if they back off on interest rates because inflation is coming down, it will lower the value of the Canadian against the U.S. dollar steamroller, which does risk importing more inflation. However, if they go too far, they're almost going to cement a recession, and there's a belief that we're going to have a technical recession anyways, and that will do a lot to bring down inflation. After a total of 3% hike in 2022 so far, Canada's overnight raise at 3.25, correct. It is widely expected. BOC will take it to 3.75 next week, followed by another 25 to 50 in December, taking the overnight to 4.25. I think that's consensus. Do you anticipate further hikes, or does this expected path of rate sufficient to bring down inflation in Canada? I'm going to give the most appropriate answer is I don't know. Nobody really knows if it's going to be sufficient. It's just sort of a best guess is saying, well, if we bring it to here, it's going to have more effect than if we left it at 2%. We can all agree with that a higher rate is going to have more effect than a lower rate. But how high do you go? We know that we have a lag, that it's going to work with a lag. We don't know how long the lag is. It's long and variable. That's all we know. You could raise it to a certain level and then hold it to see what happens, but that could be risky because what if inflation keeps going up? Then you're going to repeat the 1970s, which is why the Fed is saying they want to get to a sufficiently restrictive level, and that going too far is better than not going far enough. Because we have a dollar that's going to be affected by the interest rate, maybe Meldrum will go further than needs to go. However, I'm sure he's aware that it's not going to help the value of the Canadian dollar against the US dollar, because the US has its own momentum that higher interest rates in Canada really can't stop at this point. Can slow it down, but you're not going to stop it. So I don't know that he's going to be too focused on the exchange rate as much as the data within Canada itself. Canada is believed to be more interest rate sensitive than the U.S. due to its dependence on the housing sector and high household debts. Well, we do have that, higher household debts. I believe the majority of mortgages in Canada are 5-year fixed. Yeah, they are, I wouldn't say the majority are 5-year fixed. I don't know what the number is, but the majority of mortgages in Canada are for a short period of time. Even the fixed ones are for a short period of time, and then you have to renew them. It's not as if you get one rate and then you're good. And a couple of the banks have already sent out warnings for their customers saying, listen, this is, rates are going to reset. Be prepared. These are the numbers. So they're already a little concerned about that. Yeah, it's a tightrope that you're walking in Canada more than the U.S. because you do have to worry about that level of household debt. I don't know there's too much that you're going to do to save the U.S., save the exchange rate no matter where Canada goes. It doesn't seem to get much respect on the interest rate at all. It's not a big enough currency to absorb a lot of flows. So if you need to hide somewhere, the safest place to hide is the U.S. dollar right now. There's just the Canadian dollar just doesn't have the room it needs to absorb a bunch of flows. So I think, if we stick with consensus, that's probably it. But Meldrum, he can surprise, based on it. I'm doing this the night before Canadian CPI is released. It's 8:42 p.m. on a Tuesday night. CPI for Canada is released in about 12 hours. If that comes in hotter than expected, yeah, he could probably go with 75. If it looks like it's stepping down again, if it came down in September, again, I don't know that he's going to go 75. I think he'll probably go 50 and reiterate his data dependence. All right, first question here. Next recession cycle, will active managers be more favored compared to passive? I don't know. I think good active managers will probably be needed if you hope to beat what seems to be going to be, more tepid returns for 23, 24, 25. At least that's the forecast now, is that, with central banks not going to return to the zero line, they're not going to be doing quantitative easing. That money flowing into markets and squeezing people out of fixed income, or squeezing investors out of fixed income into risk assets, isn't going to be there. So yeah, it's going to require more than just passive investing, unless you're comfortable receiving the market return. But if the market return is going to be high single digits, well, then you're going to have to get creative. But I don't know if active will be more favored compared to passive on that one. How do you do seasonal adjustments for these data? Are there some sort of regression model? Yeah, it is. It's time series. And how you put a seasonal adjustment in is you put a lag in. So if you have y, t, which is the value of a series in time period t, equal to b naught plus b1 y t minus 1, that's the value last period. If you think that there's some seasonality in it, let's say you have monthly data, then you would put b2 y t minus 12, or is it minus 11? I'd have to pull my fingers out and count on my fingers to get there, but you'd stick a lag in for the month that occurred during that last period. If it's quarterly data, you'd use the 4th lag. If it's monthly data, you use the 12th lag. That's a very simplistic answer. It's a little bit more complicated than that, but that is how you would do it. Is you would put the a lag in for whatever period you think has a seasonality. In several of your videos, you state that when selling a put, you always win. Well, it's not that I always win. It's that I structure it such that the outcome, I'm okay with the outcome no matter what. And I get your point. If the underlying asset goes up in value, you keep the premium. Yes. If it goes down and you are called away, well, it wouldn't be called away if I sell the put. It would be put to me. You don't mind owning the stock, and you even get it at a lower price. Correct. As a result, is it reasonable to assume you are never fully invested? Not really. The level of cash that I hold is inversely related to my level of uncertainty. The more, or I should say, inversely related. The more uncertain I am, the higher the cash balance. The more certain I am, the lower the cash balance. So as the level of my certainty increases, my cash balance will decrease. And if I am not very certain at all about what to expect from week to week or month to month, like we are right now, then I will raise the amount of cash. I don't really have rules written down on the side of my computer that I say, if this, do that. It's just a feel I have. And honestly, I don't know what my cash balance is. I don't know what percentage it is. I don't really look at those things. After a while, they just become part of you, that you don't really have to, look at all of your positions and size them and worry about all of the statistics. There are usually a couple of big portfolio level statistics that you look at. And I've already explained that the dollar delta beta is the one that I look at the most. And if I didn't have options, it would just be dollar beta that I'd be looking at. And I manage that. If I'm very, very confident that we're going up, and there's no uncertainty and I feel really good about it, well, then I will move all the way to the level of the money I have. I'll keep a very, very low cash balance, and I will not mind using margin. But interest rates where they are right now, if you're using margin, you need an underlying that's going to perform very quickly, or that at least is going to outperform the margin interest rate that you have. We don't have that right now. Thanks for putting it together. I would appreciate if you could address one question. You mentioned hiding capital in short-term investment grade bonds may be a better choice as opposed to money market funds. Well, investment grade bonds, money market funds. So money market funds are discount securities, right? Investment grade bonds, these are capital market securities, not money market securities. So you're going to get a higher yield because you have some credit risk in there as well. Knowing the Federal Reserve will increase over 100 basis points over the next 2 months, the value of the short-term bonds might decrease 1 to 3%. Well, the holding might decrease, But if you're holding it to maturity, no, you're going to realize that yield. Isn't it a better choice to put capital in a money market fund since excess returns from bonds in 2 months is less than the decline in value? If your holding period is that short, if you're saying, look, I got a 2-month or 3-month holding period where I just want to sit in cash for about a quarter and then I want to go back in, then yeah, go into something very, very short, which means a discount security. You want to be in money market funds that are at the very short end of the curve, 3 months or less, and you want to hang out there. But as far as the fund is concerned, you do have to be concerned about, well, what does it cost to get in or what does it cost to get out, right? Yeah, that's if you're thinking that you're going to need this money in 2 or 3 months, then yeah, you certainly wouldn't want to go into anything that has any duration risk in it at all. Does it make sense today to invest in foreign markets to take advantage of the strong dollar and mean reverting real FX rates? Or are there other unperceived risks in these markets that make the U.S. stronger than these and these trades uninvestable? I don't know if it makes a trade uninvestable. When you're investing in a foreign market, you have to ask yourself, why are you doing that? Are you doing it because you're interested in their market or a particular stock, or are you doing it because you're interested in the currency? If you think the currency is that the US dollar will weaken and the other currency will strengthen, just ignore the stock, just ignore the market, get a safe asset to put your money in that has some cash flow, and make a certain return on the foreign currency, and the uncertain return would be in the exchange rate if you think that the exchange rate would move in your favor. If you're interested in another country's equity market or in particular stocks in that equity market, well then fine, but you are making 2 bets. You're betting on the future prospects of that market or that company, and you're betting the exchange rate will work in your favor. And you're betting both will happen in the time period that you want it to happen in. So let's say that you hold it for 6 months and that stock has risen significantly. You got a good gain. You think now's the time to take it, but the exchange rate has moved against you, thereby wiping out any gain that you made, and you have even money. So you think, well, I'll sell it later. And so the exchange rate moves in your favor. You got a great gain on the currency, but unfortunately the stock you were holding gave back its gains and now it dropped. So now you're back to even money. See, you got to be right on both of them. So you should move your money into a currency, and then with that currency buy something, and make sure that you have a broker that when you sell that something, that your money stays in that foreign currency. So with Interactive Brokers, I can convert some of my money to yen. I can go to Japan and I can buy Toyota, and I can sit in Toyota and I can sell Toyota, and I will still have yen in my account. It won't automatically convert it back to my own currency. I have yen in my account, and I can sit on that yen until I feel like converting it back into Canadian, or if I were in the US, back into the US. So you'd want to make sure that in your portfolio you can decompose that trade into its component parts. Number 1 is a currency part. Number 2 is the stock part. Some brokers don't let you do that, don't let you hold multiple currencies, but will let you hold securities in multiple currencies so that when you buy Toyota, it'll convert your US dollars to yen and you own Toyota. And then when you sell it, it will automatically convert the yen back to US. Maybe you don't want that part to happen. So make sure that your broker allows you to hold multiple currencies. Next one here, what is a good resource to study the fundamental reasons for support and resistance levels in SPY? For example, in this video, you identified a potential level of support using the VIX, and in the others, you identified potential levels using price-earnings ratio levels. This is a technical indicator. The technicians out there are probably screaming, hey, 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 that's ours. Yeah, it is. And earnings is more fundamental. When you're looking at levels on anything, any asset is worth the future is worth the future cash flow it can generate, discounted at whatever the cost of money is. Right now, the cost of money is high. The time value of money is very high because rates are very high. So any asset is worth the present value of whatever cash flow it can generate. You'd never buy an asset that has no potential to generate any cash flow. It's not an investment. You might buy it because you like the color of it or something, but it's certainly not an investment asset if it doesn't have cash flow. So fundamentally, looking at earnings is, well, that's a good proxy for cash flow. We'll just look at that and look at some multiple of that particular number. So finding a fundamental level is got two parts to it. Is what in this environment do we think is a multiple that the market would be a buyer at, and what number for earnings do we think is realistic for the next 4 quarters? And when you combine those two, you can come up with a level. Using VIX is a technical indicator. What do you think of semiconductor stocks? I really don't know because I don't follow them. It seems they are at a steep discount and will be key to future growth in the EV space. And if they are at a steep discount, there's got to be a reason why. The market must have some reason why. So you would have to, be a little bit more knowledgeable about these companies and what the issue is. The best way to get there is to get a couple of quarterly reports from a couple of companies and go through them and see what they're listing as risk factors, see what their guidance is and why their guidance is that way. Are they experiencing any margin compression over the last little while? So have a look at that. Key to future growth in the EV space is cars are increasingly smart. Yeah, the chips they use are old technology chips, though they're not new technology chips. And in the A Spice Well Alliance feels you are seeding for the next bull cycle. Yeah, I don't know. When it comes to semiconductors, I've done no work in that space at all, so I wouldn't know the answer to that. But maybe somebody else has more experience in the semiconductor space and they can answer that. Lam Research is reporting this week, so if you want some insight into some guidance, I would watch Lam Research. I really enjoy listening to your theory in the portfolio management for retail investors video and becoming an expert in a particular sector. I was wondering, what if there is no sector you particularly want to follow? What? No sector? There are 159 sub-industries in the GICS, the codes identifying sub-industries, and they're expanding in 2023. What are your hobbies? Do you like Vegas? Well, there are casinos. That's a whole sub-industry unto itself. There's gaming, software. There's just type into Google GICS sub-industries and just look at the whole list. Nothing turns you on? Nothing at all? Okay, let's say that's true. That being said, what's your opinion on becoming an expert on the particular sectors like XLP and XLE? In other words, keeping your knowledge at the level of the sector itself so you don't get into all of the idiosyncrasies, I know I'm saying that word wrong, of all the individual sub-industries and companies. In this strategy, one could learn the price action of each ETF and maybe follow a sector rotation strategy, selling calls on good days environments and puts on bad days environments, plus maybe even holding a few of the top 10 holdings that look more promising. Well, now you're going into individual stocks. Yeah, you could hang out at the sector level, very top down, in which case you would spend most of your time on cycle analysis. Is what stage of the business cycle are we in? What are the economic drivers of particular sectors, and are those drivers in place? I don't know that I would waste my time with all 11 sectors and knowing all 11 sectors and when to rotate in and rotate out. Usually there's one or two sectors that win on the way up and one or two sectors that are safe on the way down, but will still lose, but that are safe. A rotation strategy doesn't have to include all 11. For the most part, I find that, in expansions, there's 2, maybe 3 sectors you'd overweight. The rest half of them would be in line and a couple you'd underweight, and then you just reverse it in contractions. Yeah, you can do that. that would make you very top down. You're not going to be too concerned with any bottom up analysis, but very top down. Sure. Yeah, I don't see that that's an issue. But I would say there's not one single sub-industry in the world that interests you. Have a look at the list. And you're probably going to see something you like. You like Twinkies? Do you like those kind of packaged desserts? Well, there you go. There's a whole industry that makes that kind of stuff. There's a whole bunch of companies that make that kind of stuff. You could be like the guy, the go-to guy for those kind of food snacks, where somebody says, I'm really interested in getting in the food snack business. What's hot these days? What do I have to know about it? You could really know that. Okay, a long question, but an easy answer. And anyone who has been through level 3 CFA is going to be very familiar with the answer here. My question is regarding the valuation of an index. Can you please give your insights on considering buybacks and dividends as cash flow for the index? And that's what Grinold Kroner does. The expected return is the dividend yield plus the percentage change in the shares outstanding. There's your buyback component. That is your income component of total return. I've got this methodology from a sell-side research report. Forget the brackets here. The equity strategist comes up with a top-down earnings estimate for the index. The payout ratio is preset according to his conviction and the historic data. That would be the dividend yield. Finally, he calculates the index cash flow using these earnings estimates and the payout ratios to estimate fair value. I know different analysts use entirely different methodologies, and there are no accurate models. I'm baffled by one thing: combining dividends and buybacks to determine the fundamental index cash flow, where dividends are actually the cash return to investors, but investors should surrender their shares to get the capital appreciation from buybacks. No, you don't have to. You can continue to hold your shares as a company is buying back shares. In a pure sense, it should not change the price of the stock if they're buying back shares. It shouldn't change the price of the stock, but it will change the earnings per share. And if the stock has a constant multiple, it will raise the price of the stock based on a constant multiple with a higher earnings per share. So that would be the growth component, the change in earnings or the change in earnings per share. I couldn't find any adjustment so to consider to surrender shares, or maybe I'm missing something since I have access to the report. Okay, we don't need to read the rest of this. I went to this thing, and this thing just scrolls and scrolls and scrolls and scrolls, and you're trying to point out one particular chart, and I just lost patience trying to read all the charts, saying I don't need it. So this is the expected return that we would get over a short period of time is our dividend yield plus the change in shares. If we're buying back shares, the change in shares will be negative. That's why this is a subtraction. Minus minus is a plus. So buying back shares adds to the income. Growth in earnings will also raise our expected return, and the change in the PE. This incorporates a change in the PE. That is a repricing. So there it is. Okay, when you are referring to real yields, are you just talking the TIPS yield over various horizons? That's exactly it. A TIPS yield is a real yield. So let's say the yield is 100 basis points. That's your coupon, 100 basis points. And then whatever inflation happens to be, the principal increases by that amount. So you'll get 1% on principal. But if the principal keeps rising, every coupon payment you get is 1% of a higher and higher and higher number. And then at maturity, you get the inflated value of the principal. So the principal increases with inflation, thereby preserving the purchasing power of your dollars, because you'll have $1,000, let's say, of purchasing power today. And in the future, you'll have $1,000 of purchasing power because you will get the increase in inflation on top of all that. So you'll have higher nominal dollars, but still constant purchasing power. And because your coupon is 1% of a rising amount, your coupon increases at the rate of inflation as well. So what you're left with is a real yield. What are your views on selling out of the money puts on the SPY 1 month out in November around the 330 strike? Well, everything has risk, right? You have to be comfortable. You have to ask yourself this: what if I'm wrong? Am I willing to A, take the cash loss, or B, own the market at 330? If the answer to either of those two questions is a no, then you don't do it. You have to be comfortable with the outcome. I think too many people place trades already counting the money they're going to make, and they don't really give a lot of thought to, well, what if it doesn't work out? What happens? And you must be comfortable with that answer. And if you're not comfortable with that answer, you either use a stop loss. Stop losses are tricky because you'll end up taking more losses than you necessarily have to, because almost any volatility will trigger a stop loss, and you'll get knocked out when, if you had not used a stop loss, you wouldn't have gotten knocked out and you would have made money, which is why I don't like hard stop losses. I like to go into a trade knowing that if the market goes up, hey, I win. If the market goes down, you know what? I win because I would have bought at 330 anyways. So if you were going to buy at 330 anyways, and you can sell a put for, let's say, $4, that means you're actually buying at 326. Well, then you win again because you're now buying at $4 cheaper than if you had put a limit order in at 330. In the UK, some of the dividends look quite enticing and the currency is weak, so potentially good value for foreign investors. Rio Tinto yielding about 11%, assuming no cuts, BP 5%, etc. Yeah, except you have something called a foreign withholding tax. So if you find a stock in the UK yielding 10%, that is 10% for a UK investor. If you're an American investor investing in the UK, that is 10% less whatever they decide to withhold. And it could be up to 30%, which might mean it's only a 7% yield for you. And then it depends on the taxation system that you have in the US, how they treat that dividend. Are you paying tax on the 7%? Are you getting a credit for what you paid? Can you get that money back by applying to the UK government saying, hey, I live over here, not over there? Is there a tax treaty between different countries that you're investing in? Really, it could get really complicated. And after the withholding, the dividend that you get, you might be able to find 7% on a stock in your own country, right? So, you're taking on currency risk just to get a 7% yield that you could get without taking on currency risk. So if you are trying to get the whole dividend, what you should use is a synthetic. Use a 1 year out synthetic, a synthetic long position. And the synthetic long means you are going to sell a put at some strike price X, and at that same strike price, you're going to buy a call. The present value of the dividend will be in both of these. Some of it is a portion to both of these, so that when you combine them together, you have the present value of the dividend. You avoid all withholding. Because a synthetic, if you do it at the money, is usually zero cost, you also have no currency exposure at that time. So you have the present value of the dividend in the price of the options. It's a capital gain. It won't, whatever you get will be a capital gain. There'll be no dividends in there. There'll be no withholding tax, and you have very, very minimal currency exposure at that time. What is your thought on dollar milkshake theory? And I had never heard of this, so I had to Google it to find out. It's not an academic theory. That's why I've never heard of it. It's somebody who came up with an idea or a thought and then gave it a name. From what I can tell, they were really enamored by the story of There Will Be Blood, where there was this piece of land that he wanted to get a lease on so that he could drill for oil, but it was that priest, that young kid, that priest that was trying to manipulate him. So what he did was he bought all the land around it, and he put drills, oil drills, in all the land around it. So when the guy said, you can buy this, he says, I don't need it anymore. Look what I've done. I bought this, 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 and this, and I put drills in all of these like big straws down there. I'm going to suck out all the oil. I don't need to buy your property to get the oil from under your land, which was a kind of a devious strategy to follow. And I guess the guy who named it the dollar milkshake theory became really enamored by that, saying, okay, well, here's what I see going on in currency markets. I see some countries are going to have problem accessing US dollars. It's going to require more and more of their local currency to buy each US dollar. So let's take this country over here that needs to import energy and import food. Well, they're going to need US dollars to pay for this. Right? And as the US dollar goes up and their currency goes down, it's going to take even more and more and more of their currency to buy the same amount of food, the same amount of energy. And he says that's like the US putting a giant straw and sucking up all the value out of countries. Hey, you know what? I saw something like that in a movie, something like that going on here. I'm going to call it the dollar milkshake theory. it just seems like a forced analogy. This straw sticking in the ground, sucking up value. It's not really what's going on. But the idea behind it is that as the US dollar gets stronger, and this is really all it is, as the US dollar gets stronger, some countries are going to have to spend more and more of their local currency to keep supporting their economy, especially if their imports are critical and they're priced in US dollars. That's all. Just say that. Why go to some movie and say, this was a neat little story, let me make an analogy, I'll call it a dollar milkshake there. I spent so much time trying to make the analogy fit, going, okay, well, what's the straw again? And I'd listen to him again and again, going, no, it seems like you're just, that you like this movie and you like that little thing and you're trying to make it work, and it doesn't. You don't even need to say it. However, I will say this. This would not have gained any popularity, this story here would not have gained any popularity unless you called it something really, really neat that people said, what is that? Dollar milkshake theory. It'd be like if I said, if the market sells off, the VIX index typically rises. And then I called it the Meldrum sod theory. Well, what's the Meldrum sod theory? That's interesting. Well, now I'm going to have pickup on that, and more people are going to be exposed to that idea till somebody comes along and says, well, wait a minute. I mean, you're just saying something that everybody's known for such a long period of time. You're saying something of common sense and then calling it a theory of your own. It's not a theory. It's So what is my opinion of it? The story, yeah, the story makes sense, but why do all these backflips and contortions to try to give it a name when this is something that if you didn't call it the dollar milkshake theory, almost anybody would know what's going on. Why do you suddenly feel it's your theory? Would be my question. However, he's not clear in the video. I would like to sit with him and say, well, what am I missing? Because to me, it seems so obviously simple that it doesn't require a name that you put on it, because I don't think that you came up with this other than you said, hey, I see this going on. I know, I'll call it something really cool so other people can watch it. I don't know. Maybe it was PR. Maybe this was marketing, whatever. I don't know. Real yields are nominal yields minus, I guess you could say that, inflation. It's more, we call it expected inflation. The 5-year real yield at 181 means inflation in 5 years is 244. No, not quite. What the 244 is called a break-even rate. These are break-even rates. It is not an expectation of what inflation is going to be. It is the I guess you could call it an expectation. It's where you make a decision. You can buy a nominal bond, or you can buy an inflation-linked bond. You can buy TIPS. If you expect over that 5-year period that inflation is going to average 2.44%, you are indifferent to the nominal bond or the TIPS bond. If you think inflation over those 5 years is going to be less than 2.44, you'd rather have the nominal bond. If you think inflation is going to be higher than 2.44, you'd rather have the TIPS. And because of this, when a group of investors get together and let's say that this was 3%, some would say, oh, that's way too high. I think that inflation has come in lower. Well, then the nominal yields, you'd be buying the nominal yields and selling these. And you'd get to a point where the market sort of agrees. If you're at 2.44, they say, well, yeah, I guess that looks like about the average over the next 5 years. That's the number at which you would be indifferent between buying the nominal bond and the TIPS. Okay, if my mandate is to beat the benchmark S&P 500, can I simply put all the cash into floating rate corporate bonds and open synthetics with a dollar delta beta 100% of my account value? Am I missing something? Right now I would beat by the floating rate return, if I'm not mistaken. Well, a couple of problems here. If your benchmark is the S&P 500 and you're buying corporate bonds, you are now investing outside of your benchmark. So any fund manager or any asset manager that has given you money saying your benchmark is the S&P 500 is now going to say, wait a minute here. You said your benchmark was the S&P 500. Now I find out you're buying fixed income securities. I already have a fixed income allocation. You're investing outside of your benchmark. So you're kind of lying to me, aren't you? So your true benchmark is going to be the S&P 500, some combination of the S&P 500 plus some floating rate corporate bond index. That's your true benchmark. Now you have to beat that. So you can always beat a benchmark if you want to invest outside of the benchmark, but then what the hell is the benchmark for? The benchmark is saying that this is what I have to beat because you could do this passively, and if you're going to do it passively, let me show you how I can beat it. Well, if you're stepping outside of the benchmark, well then you got to let me know, because then I can construct a portfolio that could do that passively as well. So if this is what you're doing to beat your benchmark, I could then say, but I can construct this passively to do the same thing. So what am I paying you for if I can do this passively? So your benchmark must reflect your investment universe. But you wouldn't be beating by the whole yield. You would be beating by the OAS on this one. That would be it, because if you price out options, they are... you have some future value of what the option is going to be. You have some payout depending on whatever circumstance you have, and you have to think about this in continuous time. And then to determine the price of the option, it's the present value of this, which means you're using the risk-free rate. The risk-free rate would already be in the floating rate bond, so you're only beating it by the OAS. If that's the case, and I do some attribution analysis, I would find that there's a very curious return series in there. And it wouldn't take me long to figure out that you're investing outside of your benchmark, in which case it's the S&P 500 becomes what's called your policy benchmark, but it is not your true benchmark. So it's not that easy. If you have a benchmark that is the S&P 500, you must stay within the S&P 500. That's your mandate. If soon as you step out of that, you're messing up the asset manager who said, wait a minute, I gave you an equity allocation. I gave somebody else a fixed income allocation. Now you're buying fixed income. Now you're overweighting my policy allocations. I only wanted 40% in fixed income, but because of you, I now have 60% in fixed income. What's your problem, man? You're fired. Yeah, so you can't do that. Why is it that real rates are what really affect business investment if nominal rates are what the business actually pay for the money they borrow? Because nominal rates not only are what they pay for the money to borrow, but the inflation component of the nominal rate is what their cash flows will increase by. So let's say that inflation was 4% and the nominal rate was 4%. My money's free, because let's say I have a project and I forecast out cash flows. And I find that inflation is 4%, or in whatever I'm borrowing. Let's say I issue a bond issue and the coupon is 4%, and inflation is going to be 4%. If inflation is 4%, means prices are rising 4%, means my cash flows are 4% higher. So if my cash flows are going to be 4% higher and I'm discounting it at 4%, my money is free. My money's free. Now, if the interest rate is 3% and inflation is 4%, I'm actually going to do even better, because my prices will be up by 4%, my cash flows will be higher by 4%, but I'm only discounting them at 3%. That's a premium. I'm going to end up with a net present value that is positive. At the margin, it will be positive because of that differential. So you have to get real rates positive such that money has a cost for time, that you are actually paying something for the money you get. That's why the real rates matter. First time that I posted a comment since you introduced the automatic filtering, and it doesn't appear in the comments section, which is odd because I've taken out some of the common words that these people use. Dating, sexy, Bitcoin, BTC, salutations, Ms., Mrs., Mr. I've taken those out altogether. I don't know why it wouldn't work. I've taken out links because that's what the porno sites use, are links. But if you have a question and you're trying to post a link, you can always reach me on LinkedIn. If you're connected to me on LinkedIn, just send a message. If you're not, you can send an in message. I think you can do that as well. Or you can request to link, and in the message that I can't add anybody on LinkedIn anymore. I'm at 30,000 connections, and that's the limit. But you can reach out to connect, and in the message, put your link or your message in that message. I still get that. Even though I can't accept your connection, I can still get your message. So there are lots of ways around that. But I've got the deleting of the spam to, at least for the first 2.5 days, under 50, as opposed to, a couple of weeks ago, it was well over 100. It was unbelievable. It was relentless too, but I've gotten that down. And every time they slip through with new variations, they just changed variations of words. So it'll be, for Bitcoin, it'll be bit-coin, it'll be bi-t-coin, it'll be b-t-c. You got to put all the variations in there. So if you use the word Bitcoin or the word sexy, and I know some of you would like to refer to me by that word, well, you're going to be blocked. Let's see. Political topic here. Ongoing Russia-Ukraine conflict. Do you think a sanction might cause Russia to exit OPEC Plus? If so, what impact do you think it would have on oil and gas market and the power of OPEC Plus in general? When it gets to institutions like that, and especially in a domain that I don't really play in, my answer is I really don't know. Are there any trade opportunities using options on oil futures contracts given the recent OPEC news? I don't play oil using the futures or the options on futures. They are big contracts, lots of volatility. I don't know where anything is going, and I sort of have a general rule: if I don't understand something, I don't play it, because that's where you end up in trouble. If I were going to play oil, I would play it through one of the oil companies, such that I would get a dividend. And I'd probably buy Occidental because Warren Buffett is there and he looks like he really likes it. So if he wants to take it out, I'm sort of going along with him on that one. And I'm sure he's done his homework. So, I would probably just say, well, look, a guy like that's buying it. He's put in a lot of money. I don't mind buying it either. But with futures, unless you're hedging something, it's a straight up and down bet. And I don't like straight up and down bets. So I'm going to leave that one to you. But yeah, you can use options on oil futures. They're called FOPs, future options. You can use those. Big margin requirements. So lots of underlying volatility, which means you got to get comfortable with that gamma risk. Would you be able to take us through how one would go about calculating CPI before the announced figure? No, I don't know how to do that. You can estimate it. You can have some kind of estimate of what you think it's going to come in at based on what you know about how prices have moved in certain categories over the month. But it's just a guess. It's just an estimate. Nobody really knows. If I could do that, if I could calculate the CPI before it was announced, I wouldn't be doing any of this stuff. I would be calculating that number every month, and I would be selling it for thousands and thousands and thousands of dollars to hedge funds all over the world. I'd be a pure multimillionaire just on that if I knew how to do that. And if I did, I wouldn't be telling you. Until it no longer worked, then I'd write a book telling you how I did it, and then you would be the trade. Next one. Regarding the price action after CPI day, I read some vol traders justifying it with Vanna flows once there was an IV crush and the put activity with blah, blah, blah. I'm not going to read the rest of that. Okay, so vol traders are trying to justify what happened based on what their world looks like. That's human nature. When something happens, you will try to, we don't like things that don't make sense, so we try to put a story to it. Why did this happen? And we tend to explain it in terms of what we're familiar with. And if you're sitting around trading vol all day, you're going to have a vol story of why that happened. That's all. So sure, it's not surprising that vol traders would try to explain it, that action based on something that's happening in their world. How much do you think is required to start trading with options? Not enough knowledge. It's not about the amount of money that you need. It's about the amount of knowledge that you need. I bought your Apply course. So yeah, it's about being comfortable with what you're doing, as opposed to saying, there's no answer saying, if you have 5,000 you'll lose, but if you have 20,000 you're going to win. Nah, it doesn't work that way. If you don't know what you're doing and you have $1,000,000, you'll lose. If you know what you're doing and you have $10,000, you'll win. So it's a matter of knowing what you're doing. I would say you'd want to paper trade for a long period of time until you consistently generate profits paper trading, and then slowly move into cash trading. The goal is to make money, not to gamble, but to make money. So there's going to be a period of time where you're going to apprentice, and that is what paper trading will do. Make your mistakes there. Learn why you lost there, as opposed to the real world where it's real money and there's no give backs at the end of the day. All right, somebody smuggled in 5 questions in one comment. Regarding the Fed with the balance sheet runoff, the Atlanta Fed said it's equivalent to 0.29% interest rate hike. Is it possible the Fed could increase the balance sheet runoff but reduce the interest rate hikes? Sure. My assumption is that the main concerns of this would be increased strain on liquidity and less pressure on the housing market, which the Fed is using as its main disinflationary source. Don't know that the Fed is using housing as the main disinflationary source. I think that's just the outcome. Big ticket items will be hit first. Interest rate sensitive sectors get hit first. I wonder if the Fed were to ramp up its balance sheet reduction, would this position it better for the next recession where an injection of liquidity would be beneficial? Sure. Would this also have the effect of reducing the correlation between bonds and equities? Most likely, if they're no longer buying it in all markets, it would reduce that correlation. Yeah. Regarding clean energy, no idea. I know nothing about this ETF, and I'm not gonna give a Kramer answer. Buy, sell. I know nothing about it. Regarding bonds, I know it's dangerous to buy something that is low. Okay, for this one here, all I could say is you got to do what's right for you. If this is something that you want to do and you feel comfortable with it, then sure. I don't know anything about you. I don't know what your portfolio looks like, what your income looks like, what your level of wealth is, what your risk levels are. I know nothing about you. And there is no one-size-fits-all sort of trade to do. So if you feel comfortable with it, that's fine. But the conclusion you get to down here, do you think it's attractive to pick up discount bonds at short to medium maturity that will amortize to par while collecting a coupon? Sure, if that's where you feel comfortable, sure. Could this be a simple hedge against the prospect of Fed cutting rates faster or increasing less than anticipated? Yeah, if this happens, yields will come in, and that will push up the value of those bonds. You'll get some capital gain on that as well. So if you were thinking that you are going to anticipate the end of the rate hiking cycle or the beginning of a rate cutting cycle, sure. But what would cause the Fed to cut rates would also cause those credit spreads to blow out. So even though rates may be dropping, credit spreads may be widening faster, but if you're in IG, 1 to 3 year IG, you're probably going to get your yield and your money back. Do you have an opinion on the commercialization of space? Nope. If you had unlimited time and research funds, what is some market economy related you would like to study more? If there was something I'd like to study more, I'd already be doing it. So I'm right where I want to be. So I don't have an issue with funds at all. I just, I have an issue with time, but I'm spending the time doing what I want to do. I don't know that if I had more time that I would do something different. I think I would just do more of the same thing that I'm doing now. When you sell a covered call or a cash secured naked put for 1 month, how do you deal when there is earnings results in the meantime? Do you risk keeping the options? I would have known that, especially if it's on individual stocks. I would have been aware of that. So I would be comfortable holding through. I'm not going to let an event like earnings knock me off my path. If earnings coming good, if earnings coming bad, it's just an earnings report, and it largely reflect the problems in the economy. I'm careful about what stocks I'm interested in. I'm not interested in every REIT, for example. There are some that I just don't like that I wouldn't want to own. Others I'd want to own, and if they earnings come in lower than expectations, chances are it's going to come in lower for everyone in the sector. if good companies have poor earnings, then poor companies will have even worse earnings. Components of XLRE and IYR are largely identical. IYR has about 80 components. XLRE, I think, has about 32. But the top 5, the top 10, I think, are identical. This is large cap, and this is a mixture of large cap, small cap. Short interest on the latter one is almost 10 times higher. IYR has been around for a very long time. XLRE, only about 5 years, because prior to 5 years ago, there were only 10 sectors to the economy, or 10 sectors to the S&P 500. Now there are 11. REITs that historically were in the financial sector got spun out into the real estate sector. So it's fairly new, and if you're doing anything with options, IYR has far more liquid options than XLRE does. But XLRE is large cap. So you're not really playing the whole space with XLRE because it's an S&P 500 component only. Let's see. Now that interest rates are rising, we are seeing the effect of cap rate expansion on REITs. Yes. If we stay higher for longer, wouldn't our R in the denominator stay the same? Well, the R would rise, yes. If so, this would mean that NAVs of REITs will keep experiencing downward pressure, thereby limiting further upside potential. Well, your net asset value is a function of two things, right? All assets are worth the present value of their future cash flows. So you have cash flow, and then you have your discount, whatever you're discounting it by, and you're making the case that, well, this is going up, so your property value is over here, right? So that your property value would be decreasing. But keep in mind, with inflation, your cash flows are increasing as well. So you have to look at your numerator, and you have to say, well, what is my G? R is elevated because inflation is elevated. Is for the REIT that I'm holding, can I pass that through to the G? And if I can pass that through the G, well, then the downward pressure on property value isn't going to be as high, because if your cash flows are increasing at a rate faster than your discount is increasing, you can actually stabilize or even increase your property value. Let's see, downward pressure limiting further upside potential. Could we possibly see a rebound back to the levels of 2020, 2021, or will this take either years of growing cash flows, lower interest rates in the long term? Getting back to 2021, you're going to have very low interest rates, no reason to be in fixed income, which means that there has to be no other choice but to go into risk assets. So, but if you leave any kind of yield in fixed income, well, that money that could have gone somewhere else will stay in fixed income. And that is the thinking that coming out of this, that we're not going back to the zero line unless you start to see that the threat of deflation, that interest rates may get cut back down, and we might end up with an overnight rate at 2 to 2.5%. Well, then that gives fixed income and money market funds some viability that they otherwise didn't have when they had like no yield on them. So that money is not available to go into other things. I don't know if we'll get a cap rate that we had in that period of time again, but when you're holding a REIT, you're getting that cap rate. So you can either get a low cap rate with some capital appreciation potential, or you can get a high cap rate with lower capital appreciation potential, and then you just use the options to double the cap rate. It really wouldn't matter to me what kind of environment we had, as long as I still have liquid options. And it would be nice if volatility were permanently higher. That would be beautiful. Not a technical question, but a practical one. How do you stay sane in the current market? How do you stay true to your thesis, and when do you decide to step away from it? Recently, we've been experiencing so much volatility, it's been challenging to pick an overall direction. Well, I don't pick an overall direction. I'm not too concerned about the direction. I have a feeling for where I think the market is going to go, but I structure my portfolio such that my exposure to market risk is either higher or lower depending on how I feel. And I have different time horizons in my portfolio. I have some positions that are there as hedges for days or weeks. I have long-term holdings, and I do have some positions that are early, that I know I'm early, but they're small. I'm building a small position now because I never know when things are going to change, and these positions are for the next cycle. So it's not. I don't spend a lot of time forecasting the direction of the market as much as I do how I want to balance what I have. So think about hedge funds, and if you have long only, you have long short, and at the other end you have dedicated short. When I'm absolutely certain that we're in an upward primary trend, I'll be long only. Very rarely will I use short positions unless I'm selling calls on stock I own that has appreciated significantly, and I want to either have them called away from me or generate extra money, but I'd rarely use short positions. I'm never dedicated short. That's a tough game to play, to be dedicated short. You need nerves of steel for that. So I am long short, and the balance between long and short depends on where we are in the market. As we sell off, I become more long, and if we're rallying and it seems to be nothing more than either a short covering rally or a technical rally, I will then increase my short positions. How do I know it's just a technical bounce or a short covering rally? We will truly enter a new primary trend only when the Fed has stopped raising rates. And right now, we don't know when that's going to be. We have an idea that it might be December, it might be the first quarter of 2023, but they're going to raise rates in November. We know that. Let's see what CPI looks like when we get the November report. We'll see what they'll do in December. But the market won't enter a new primary uptrend, or at least a sideways trend, until that happens first. So any rally that happens before the Fed has done raising rates, in my mind, is an opportunity to add short positions to my long positions. Obviously we're down this year, but on the way there we keep seeing these irrational rallies that seem to have no real ground except for hope and expectations about the Fed pivoting on really good earnings. What an excellent opportunity to sell calls on those rallies. You see these rallies happen, you sit back, you wait, and then sell some calls. Sell some calls, little at a time. It keeps going up, sell a little more, sell a little more. Now you're short. You got to have nerves of steel. You got to be right, or at least believe you're going to be right, or you're going to get knocked out. You're going to start thinking, oh, the market's going to go straight up, it's all over, and I better hop on board. Let me close and go long, only to watch it fall again. So you have to ask yourself, without the market in front of you, what would cause a new primary bull market? Because we're in a bear market now. What would cause a bull market? Well, this nonsense has to be over. Inflation has to be over, or the fight against inflation has to be over. One of those two things has to end. Inflation's going to take a long time to drift away to nothing, which means the very first thing we need right now is the Fed to stop raising rates, to say, okay, now we're on hold. All right. If you're on hold and you're not going higher, there's no need for the market to go lower. Maybe it doesn't go higher, but it doesn't go lower. As long as earnings can hold up in this regime at whatever level they are, and earnings are not going down anymore, that's it. Here's the bottom. We first must find the bottom. Once you find the bottom, then any rally from that, I would not short. But until we get there, any rally is really short covering or a technical bounce. How would you recommend less experienced traders navigate through the current market environment? Well, you got to get experience, but experience happens on a timeline. You have to live to get experience. There's no super fast way to get experience. It's just you have to see different market cycles and different market regimes. It's really just opening yourself up to what other people are saying and have an open mind. Listen to what people, more experienced people are saying, and think about it after and say, well, can I take anything away from that, or is this person talking their book? Or, I listen to some people that when I listen to, I say, okay, they know what they're talking about and they're smart. And I listen to other people who go, okay, well, you don't know what you're talking about, and you're talking in statements like with rates this high, nobody's going to want to buy a house. Nobody's going to want to buy a house. When I hear somebody say that, it's like, okay, I'm done. I can't listen to you anymore. Okay, 3 questions here. Let's see. Some of us don't have access or the knowledge needed to trade these options. I was wondering what you would do if you didn't have access to options. Let's assume you have 50K, and I think the logical thing to do is divide your capital into 3 or 4 parts and then start to buy instead of buying it all at one time. Am I right? Well, it depends on what you're buying. It depends on what your time frame is. Depends on your age. Depends on what you hope to accomplish. So many questions that I can't, you just can't answer that and have one answer that fits everybody, because everybody is different. Everybody has different motivations, different levels of wealth. I mean, is 50,000 all you own in the world, or is 50,000, a small portion of it? Do you have a job? Do you have consistent cash flow? Are you young? Are you old? Are you near retirement? If you had a drawdown of 10% of your money and you went to 45,000 while you were holding it, would you panic? Would you sell? Would you, do you have weak hands, strong hands? So many things. If you don't have access to options, if you're in a market where you just don't have a great options market, Canada is one of those markets where, there's options, there's an options exchange, but they're not that liquid, they're not that great. There's a few products that have very good options, but it's not as deep and wide as it is in the U.S. So I trade the U.S. market specifically because it has that ability. But if I couldn't trade options, well, the game just got a lot harder. In which case I would be active if I had an advantage in something, if I felt that I could analyze a stock better, and I would be passive otherwise. That's about the best that I can offer. What are your views on Jamie Dimon's latest speech? I said the S&P could yet fall by another easy 20% from current levels. Yeah, it could. 3,000, 3,200. I've heard those numbers thrown around. More and more. So, yeah, it could. Do these kind of guys have any sort of conflict of interest? I don't think so. You could make the case that, well, if I'm a bank CEO and I say, listen, you could have another 20% downside in the market, that I might be using it for cover. That if things don't improve, it's because of the market. I can't fight a retreating market. And then if things do get better, well, then good enough. I didn't need the cover. So it could be that, but I don't know that he's being unrealistic. You have 2022 earnings that are expected to come in around 220. I think last number was 222. And if you get a recession in 2023, earnings will fall by at least 10%, sometimes as much as 20%. But if we put 10% down on that, you get to about 201. And in recessions, multiples can average between 14 and 16. So if you put a 15 on there, you're at 30-15. So it's not a difficult stretch to get to 3,000 on the index. But there are 2 big assumptions in there. 3 assumptions. Assumption number 1, you enter a recession in 2023. Do you believe that or not? Assumption number 2 is you have a 10% drop in earnings if you enter that recession. Do you believe that or not? Assumption number 3, the market will assign a multiple of 15. Do you believe that or not? So each of those assumptions have upside and downside risk, and each of those assumptions have their own dispersion. So it's, somebody may say, well, I place a lower probability of a recession in 2023. So you might say, well, maybe we don't have 10% earnings drop. Maybe we have 5% earnings growth and we get to 235. And, the market is feeling pretty good. Maybe it wants to trade to 16.5 times those earnings. So if you multiply that out, you'll get your price target. So you can go through that exercise on your own and see how you feel about the different numbers you get to and the dispersion that you would get to. So you could just draw a decision tree. right? And then you could place your probabilities of recessions. You can come up with the price targets based on what probabilities. You can come up with a weighted probability for your expectation, which would be the middle of your distribution, and then determine how you feel about that. About the financial sector, recent earnings, can you help us a bit? Don't know what you want me to help you with. That's a big question. If you're saying everything, well, that's a big ask. That's a really big ask, because how many banks do you want me to go through? How deep do you want me to go through them? I mean, that could be a 20-hour seminar all on its own, going through each bank statements and earnings and trying to make sense of it. But when you say help us a bit, more specific questions on that. Anyways, that's it for the Q&A this week.